What is up, guys and girls, and welcome to my first YouTube video on Dectors Investing, the channel which I'll be documenting my dividend investing journey, sort of showcasing my portfolio and showing you the stocks that I buy and sell, but also giving you the reasons on why I buy and sell these stocks as well. With the ongoing plan of growing the portfolio month by month and hopefully seeing a decent return on my investment. So I began this journey depositing £1,100 into my Freetrade account. And as you can see, I've made two investments so far. 11 shares in Unilever, which costed me an average price per share of £43.20. And also I purchased 101 shares of HSBC with an average price of £5.86. A little bit of analysis behind why I purchased these companies. To begin with, Unilever is a massive brand. I use Unilever products every single day. They own subsidiary companies such as Ben & Jerry's, Lynx, Shaw, Domestos, Dove. There are many more. They're just a few that I can name off the top of my head. So for me personally, I see them as a very sort of safe company. They're very well diversified with lots of different companies bringing in, different revenue streams. And as you can see, they have a market capital of £104 billion. So let's be honest, they're not going anywhere anytime soon. If we jump more into sort of like the financial side of things, Simply Wall Street currently give it a 44.9% undervalued percentage in comparison to its fair value. Unilever has been as high as sort of £53 this year. And at its current price, I see Unilever, as a massive sort of buying opportunity right now, and one that I'm hoping to see, good capital appreciation gains in the future. If we have a look at its price to earnings ratio, it currently has a PE ratio of 14.4 in comparison to its industry of 22.9 and the market at 18.3. To me, as it comes massively under its comparables, this suggests that it is a good buying price at its current price. PE ratio isn't always a great indicator in terms of growth stocks. However, applying it to Unilever, I think it fits it quite well, and sort of was one of the criteria that I looked for when doing my analysis. If we go on to its dividend, it currently has a dividend yield of 3.2%. This isn't something, massively to write home about. However, I see it as a consistent dividend. It's a decent dividend, and they have increased it for the past 10 years. So I'm hoping, with the capital appreciation that I'm hoping to see, my yield on cost will be a lot greater than this sort of 3.2%, along with, the increase in dividend, year on year, hopefully. And if we ever scroll down, it has good dividend coverage, with a payout ratio of 44.8%. Moving on to HSBC. One of the reasons why I purchased HSBC is that I currently own this stock in another dividend portfolio of mine, and I've seen very good returns from it. I've owned this stock for years, and I'm currently sitting at a 33% capital appreciation profit right now. That's not including the dividends that I've earned over the years. And off the top of my head, I remember it being around sort of 60 to 70% at one stage. As the stock has been sort of as high as £44 this year. Upon doing my analysis and having a look at the graphs, to me it seems like HSBC has sort of rode out the worst of it and seems to be back on the rise. If we look at the financial side of things, its price to earnings ratio is 12.1 in comparison to the industry of 13 and the market of 18.9. Again, as it comes under these comparables, I see this as a buying opportunity for HSBC, meaning that I'm going to get sort of a decent price. And like I've said, I've seen the stock higher than its current price right now, and believe that it will get back up to those highs again. If we have a look at HSBC's dividend, It has a dividend of 6.55%. Again, this is a very good dividend, but one thing you have to be careful with high percentage dividends is that it comes with risk. The higher the dividend, usually the riskier the company. But like I said, I've owned HSBC for years, and with the analysis that I've done, I don't think it's as risky as the high yield makes it out to be. They've paid a dividend for the past 10 years, ever since the financial crash. And if we have a look at its dividend coverage, it has a 79% payout ratio. Therefore, I see the dividend being pretty safe. I don't see it getting cut anytime soon. And along with the capital appreciation, I'm hoping, again, that 6.55% yield will be even greater yield on cost. So that sort of wraps up my first episode, and just sort of outline my portfolio. I plan to add capital to this portfolio every week. I sort of plan to add stocks to this portfolio every single week. And hopefully, we'll get the dividends and we'll grow this portfolio month by month. So that's sort of all I've got for today's episode. If you've liked it, please give it a like. And if you're interested in seeing more of these, subscribe. And again, just in the comment section down below, drop me a comment on what sort of stocks you're invested in. I'm always keen to see what other investors are currently looking at and how they see the market, as we all see it differently. We all have sort of different ideas and different values and different sort of goals. So I'm always interested to see in what other people are investing in. So until next time, guys,